You spend months navigating university admissions, securing a visa, and packing your life into a few suitcases. Then, right at the finish line, your personal finances hit a hard roadblock. You try to apply for a standard credit card before you leave, and traditional banks reject the application immediately. Without Indian salary slips or an established credit history, you look like a liability on paper. This leaves many students arriving abroad with only an Indian debit card. Operationally, that is a nightmare. You will constantly run into 3D secure OTP blocks when trying to book airline tickets or pay for local services. Every time you tap that debit card at a grocery store or cafe, the bank slaps a 3.5 to 5% foreign exchange markup fee on the transaction. Looking at this matrix of student financial options, the standard debit card drops squarely into the worst possible category. It is easy to acquire, but forces you to pay a heavy financial penalty while offering very little utility. There is a fully approved workaround to bypass this rejection cycle before your flight: the fixed deposit-backed secured credit card. You lock liquid cash into a fixed deposit. The bank bypasses income proof and instantly issues a credit limit tied to that cash. All secured cards guarantee approval, but treat international students very differently regarding fee structures and utility. This brings us to a central trade-off. You have to decide if it makes sense to lock up your limited, precious capital in a fixed deposit right before an expensive international move, just to gain independent credit. To figure out if losing that immediate liquidity is worth the hassle, we need to run the numbers and see exactly how these cards perform in the real world. First, let's look at the legacy banking options. SBI, ICICI, and Axis all offer secured cards that carry high brand recognition. To access these options, you will need to lock up a minimum fixed deposit of 20 to 25,000 rupees. Warning tone. However, these legacy options charge a 3.5% foreign exchange markup fee on every single overseas transaction you make. Compare that to the IDFC FIRST WOW card, which is structurally optimized for international students. For a 20,000 rupee minimum deposit, the IDFC card gives you a lifetime free status and charges exactly 0% in foreign exchange markups. While your money sits in that fixed deposit, it also earns a solid 6.3% annual interest yield. Going with a bank simply because you recognize the name will actively train your budget every time you spend money abroad. To prove this, we can look at this equation, the true annual card cost formula. It takes your forex markup multiplied by your annual spend, adds the annual fee, and subtracts the interest earned on your deposit. The critical multiplier here is the forex markup against your total annual spend. This is where most students lose money. The second half of the equation shows the bank's fee minus the interest they pay you back on your locked capital. Let's apply a modest baseline. If you spend 30,000 rupees a month abroad, that equals 3,60,000 rupees in a year. If we run the numbers on the SBI Unnati card, the forex bleed overwhelms the interest earned, resulting in a net cost of 10,975 rupees. Switch those variables to the IDFC FIRST WOW card, and the forex fee multiplier drops to absolute zero. The math is clear. By eliminating the fees and keeping the interest, the IDFC card actually gives you a net positive financial gain of 1,575 rupees a year. The math favors locking away 20,000 rupees, but that is simply not possible for everyone right before paying tuition and buying flights. If you need a lower barrier to entry, the Kotak 811 DreamDifferent card is currently the most accessible option in the market. It only requires a 10,000 rupee fixed deposit, and it gives you a very generous 90% credit limit against that cash. However, lowering the entry barrier means sacrificing the zero-forex perk. You will still pay that standard 3.5% markup on your purchases. If you want to keep your cash liquid, there is a capital-free alternative: obtaining a parent add-on card from banks like HDFC or ICICI. This piggybacks on your parent's primary account limit. You do not need to provide income proof, and you do not need to lock up a single rupee in a fixed deposit. Keeping your cash flow liquid via a low deposit or add-on card is a valid strategy, but you are trading away your own independent financial yield for immediate convenience. Once you have your card, you must navigate operational hazards. This is what you face at checkout counters, regardless of your card choice. Merchants will frequently offer to bill your card in Indian rupees instead of the local currency. This is known as the dynamic currency conversion trap. Accepting this convenience adds a hidden 4 to 8% markup above the standard mid-market exchange rate. Always decline this offer. Insist on paying in the local currency, whether that is euros, pounds, or dollars. You also need to understand the current Indian tax regulations to avoid unnecessary anxiety. International credit card spends are fully exempt from the steep 20% tax collected at source. That tax applies to debit or wire remittances over 10 lakh rupees, not your daily credit card coffee runs. Finding the mathematically perfect card means nothing if you lose your savings to predatory merchant conversion tricks at the register. With 20,000 rupees, choose IDFC FIRST WOW. If not, pick a parent add-on or Kotak's 10,000 minimum. Whichever you pick, manually activate international usage in your app 5 days prior and verify your limits. To build an independent CIBIL score abroad, follow 2 strict rules. Keep your credit utilization under 30% of your limit and repay the full balance every single month. With disciplined use, you can realistically target a prime CIBIL score of 680 to 730 within 5 to 6 months. Once you hit that score, you execute the transition plan, graduating to premium unsecured travel cards like the ICICI Saphiro or Axis Neo. Starting with the right card avoids unnecessary fees today and establishes the credit history you'll need to access more advanced financial products in the future.